Hello guys, welcome to our first class. So in this class, what we're talking about is how to start trading and the types of trading orders. Now, for you to be able to start trading, you need to first of all do analysis. You need to do an analysis of what the market is doing. You need to understand what the market is doing now, where the market is going to, and when you want to join them to go in that direction that you think they are going to. Now, let me use this as a reference to make drawing. Now, if you are a trader, you understand lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high, lower low. You understand this to be what? A bearish structure. This is a bearish structure in the sense that the market is going down or the market is going bearish, whichever way. And as it's going in a bearish structure, it is breaking previous low, forming a new low on its way down. Vice versa, a bullish structure, we are going higher high, lower high, higher high, lower high, higher high, lower high, higher high, lower high, higher high. And as we are going, we are breaking previous high to form a new high. That's what makes it either a bullish, which is this one, or a bearish structure, which is this one. So whenever you see the market going down, meaning that the market is going in a bearish structure, and whenever you see the market going up, meaning that the market is going in a what? In a bullish structure. That is just the way the market is, and that's what we understand by bullish and bearish structure. Now, the key is not just knowing if the market is going in a bullish or a bearish structure. The key is understanding when to join the market in a bullish or a bearish structure, or when to join the bullish or bearish structure. Now, before we go into much of the details of how to join the market when we come into a bullish or bearish structure, you want to know that in a bearish structure, which is this one for example, you want to trade at the tip of this place, which is the lower high, at the tip of this place, at the tip of this place, at the tip of this place. And in a bullish structure, you want to enter at the bottom of this place, 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 and try to catch the movement from this bottom to this very tip at least, or from this bottom to this next high, 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 and so on and so forth. The same way in a bearish structure, you want to catch from this tip to this next low, 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 and so on and so forth. Now, that is basically what you want to do as a trader looking at a bullish or a bearish structure. You want to be able to catch the market moving from this high to this tip, from this high to this tip, and with that alone, or with that being said, you are sure of making profit whenever you catch such trade. Now, before we continue, there are three orders in the market. We have stop order, we have limit order, and we have instant order. Now, let's take the first one, which is stop order. Now, for a stop order, we want to see the market, and let's assume we are in a, let me do a very simple bullish structure or a very simple bearish structure. Now, this is a very simple bearish structure. You understand what I mean by this? This is the last low that you want to catch. Now, for a stop order, you want to use, in a bearish structure, want to use this tool called short position tool, and in a bullish order or a bullish trade we want to use this tool called long position tool. So if you've already learned how to use trading view, you should understand how to get this tool, but I can still show you. You can click here and go and look for, you click here, projection, and go and look for long order and short position and mark it as favorite. Now for a bearish structure and we're trying to catch a bearish trade, you want to take a short order, and this is a stop order. Pay attention, this is a stop order. You want to ensure that the market goes from wherever it is going high, then you place your order. That's when you now place your order below the market high. Once the market has gotten to this area where you now see, okay, it's either coming from a trend line and you want to trade from the trend line, you want to place your entry below the previous high so that the market would come into your entry this way and continue to your profit target. That is a stop order in a bearish scenario. Now let's look at a stop order in a bullish scenario. Now we all know that this is a bullish scenario. Let me take this down a little bit. Now in a bullish scenario, we want to use the long position and want to place our stop order like this. Now our stop order, we want to see the market has already come to our point of interest where we plan to enter the market from. Let's say there is a trend line happening like this, has already touched the trend line, and the market is now pushing outside of the trend line. So the trade gets triggered after the market has already touched the trend. Just the same way here, the trade gets triggered after the market has already touched the trend and started pulling out of the trade and all the way into our profit target. So for long position, short position, we have it here that you can place your settings. You can place your settings for your position entry like this. The color for stop color, you can put it as gray. Mine is gray. And profit target, you can put it as blue. Mine is blue. And that's that. When you finish placing it, it's going to look like this. The stop is gray, the profit is blue. Now for stop order, there are informations that you are going to get when you are trading a stop order. When you look here, you're going to see information here, and information here. These three information means different thing. Now the information here is showing you the pips. So you must have learned about pips in our basic course. The amount of pips it takes for the market to run in before the market gets to our loss or hit stop loss. The risk to reward ratio, risk to reward meaning that for every amount of loss you take, for example, we have 34 pips stop loss. If we are to have 34 pips take profit, we are going to have a 1:1 risk to reward. That means for every amount of loss you are taking, it is equivalent to the same amount of profit you would get if the market goes in your favor. So that is what risk to reward is. Now if we multiply 34 times 2, which is 68, so if we take this to 68%, 68 pips profit target, if we take this to 68 pips profit target, as you can see here, we now have a 1:2 risk to reward. We now have a what? Okay, this is 69 for it to get 1:2. We now have a what? 1:2 risk to reward. If we take it further again, we have a 1:3 risk to reward. Now what does that simply tell you? That for every, let's say you are risking $100 if this market goes against you, for every $100 you risk for the market to go against you, you plan on getting either times 1, which is 1:1 risk to reward, or times 2, which is 1:2 risk to reward, or times 3, which is 1:3 risk to reward. So for 1:1 risk to reward, for every $100 that you'll be risking for a particular entry, you plan on getting $100 back for a 1:1 risk to reward. And if it's a 1:2 risk to reward, for every $100 you are risking, you plan on getting $200 back if the market goes to your profit target. And if it's a 1:3 risk to reward, for every $100 you are risking, you plan on getting $300 back if the market goes in your favor. So that's basically about risk to reward and also pips. So we record the market movement in terms of pips, and like I said, if you have taken the basic course, you should have already known what pips is. And if you don't know what pips is, our social media channel, our Discord, our Instagram channel, our Twitter channel, our TikTok, and all our social media channel, this is the best time for you to join them, because we give out a lot of free information on all what we teach on our social media channel for free. Is everything related to intermediate trading. So if you've even been going through our social media channel, you will see a lot of information about all what I'm about to teach you in this entire intermediate course, and you are getting it there for free. So whatever is confusing you here, you don't really know or you don't really understand much of what I'm explaining, you can always go back to our social media channel and relearn it for free, absolutely free. And this thing is what lots of people are giving you, or lots of people in the industry, on the forex industry, are selling to you for $500, $1,000 and thereabout. But here I'm giving it to you for free, and even posting it on all our social media channels for free. Now we've basically explained what it feels like to understand risk to reward, 1:2 risk to reward, 1:1 risk to reward, 1:3 risk to reward. And why I gave out that information is because for intermediate trading, most of your entries are going to be within 1:1 to 1:3 risk to reward, and 1:3 risk to reward is going to be a very good entry. So you should be looking for an average of 1:1, 1:2 risk to reward trade, meaning that for every $100 you choose to invest or choose to risk, you are getting $100 back, and for every $100 you choose to risk, you are getting $200 back. And whichever amount you choose to risk, you're getting 1%, you're getting 100% back, or you're getting 200% of whatever you choose to risk. And I can tell you that some of the best traders in the world use this simple strategy, this simple technique of intermediate trading, and are able to make a whole lot of money from trading. So don't look down on whatever you're learning. Take whatever you're learning seriously. If you're comfortable using it and you're comfortable making 200% of whatever you are risking per trade, or if you are comfortable making 100% of whatever you are risking per trade, you decide to risk $50 and you're making $50 back, you decide to risk $1,000 and you're making $1,000 back from that trade. That's very good. It's a very, very, very good trade. It's a very good trade. It's a very good investment. It's a very good trade for you to be able to make 100% profit of whatever you are risking. I'm not telling you of your entire equity or of your entire capital. You have to go to your risk management calculator. You must have learned about how to use risk management calculator in our basic class. You have to go to your risk management calculator and and agree with yourself, how much am I willing to risk on this single trade? If you have a capital of $10,000 and you decide to risk $100, or you decide to risk $1,000 on this particular entry, you already know that if this market moves against you, you would lose this $1,000 of your entire $10,000 capital. But if your market goes in your favor, you would make $1,000 back, which will put your entire portfolio at $10,100. But if you lose, your entire portfolio will go back to $9,000. So it is because of the amount you have chosen to risk, which is a very good thing to do. You chose to risk $1,000, now you are getting back $1,000. You chose to risk $1,000, you are getting back $2,000. You chose to risk $1,000, you are getting back $3,000. I can tell you, whoever you are listening to this, I'm categorically telling you that this is a very, very good thing to do. It's a very good investment to make, to risk $1,000 and make 100% profit in maybe a day, 2 days. You are making 100% profit of what you agreed to risk. I'm telling you, it is a very good way to go about it. Any investment in this world, it is a very good way to go about it. Now, still on our stop order. Now, for our limit order, you want to take the trade immediately. You want to place the entry somewhere before the market gets to the trend line. So we already have the presence of our trend line. We want to place the trade as the market is running towards the trend line. The market now triggers your entry. Then after triggering your entry, the market can decide to go, maybe move before coming back into the trade and hitting your take profit. This is another entry type or order type. It is called limit order. So when you hear limit order, it means that the market is you're supposed to place your entry first, then the market is supposed to ride into your entry, go into the entry and come back outside of the entry. Me personally, for advanced trading that I do, I mostly use stop order rather than limit order. But I just want you to understand the different concepts between limit order, because whenever we're dropping signals, we differentiate between limit order and stop order. So I want you to understand the difference between limit order and stop order, so that whenever I drop a signal for you on our Discord or on our Telegram channel, I give out free signals on our Discord and our Telegram channel. Aside from all other benefits you're going to be getting, you can easily be able to tell if it's a limit order or a stop order, and how to place your trade based on limit order and stop order. Vice versa, for a buy order, you want the market to come into your trade and spring out as a limit order. Now finally, for an instant order is that whenever you just get the feeling that yes, the market is ready to move in your direction, you just want to dive in instantly. Wherever the market is at that point, let's say the market is here currently, you can see the market here currently, and we are planning to take a short trade from this place. You just want to dive in immediately, set your stop loss at the previous high, set your take profit at the next low, and then say we want to set our take profit at this low. You just want to dive in immediately. You don't want to wait for the market to either ride to a particular place first before coming into your entry. So let's say this, if we were to trade a stop order here, our stop order would be like this. We wait for the market to go up and start coming back down into our entry. If we were to trade a limit order, our limit order will be like this. We set the order, the market has to go into the order first before coming back into our take profit target. But for an instant order, where the market is currently is where you just want to dive into the market and place the trade. So basically that's that for order types, and that's that for how to start trading. You need to understand the order you're taking. You need to first of all understand the direction you want or you feel the market is going before you now say, okay, it is at this point I want to join them to take the entry. Now also in this course, I just remember that I taught you about take profit. Take profit is the level where you plan the market to get to and you take profit, and stop loss is the level where you want the market to get to before you get out of the trade. But I'm going to teach you in the next course comprehensively what take profit and stop loss is. Have a nice day.